Dear students, welcome to the session on assessment year, previous year and basis of charge of income tax. I am Dr. Vishal Pinto, Assistant Professor in Commerce, GFGC Punjalagate. So in this session, we are going to discuss what is assessment year and also what is previous year and how the income tax is charged and some other definitions of income tax act. Okay, so let's go to the first one, that is assessment year. The meaning itself says assessment. Assessments in the sense you examine, you make an examination how much income that you have earned. That is assessment year. So assessment year in the sense you totally assess how much income that you have earned. So that year is called as assessment year. So it is as per the section 2 subsection 9 of the Income Tax Act. But let's see what's the meaning of assessment year as per Income Tax Act. So it's a period of 12 months commencing on 1st April of every year. So as per Income Tax Act, assessment year is a period of 12 months commencing on every 1st April. Okay, it will always commence from 1st April of every year. So from 1st April, if you take 12 months, it will end in the next 31st March. So the year in which income is earned is the previous year. So year in which you are earning the income is called as previous year, in the sense previous, okay, before the year. Then, and such income is taxable in the immediately following year, which is the assessment year. So in the next year you are going to pay the income tax. You are going to assess how much income you have earned in the previous year and you pay the tax in the assessment year. So that's the meaning of assessment year. So you assess the income and pay the tax based on the income that you have earned in the previous year. Okay, income earned in the previous year, 2000, example, this is example, income earned in the previous year 2019-20 is taxable in the assessment year 2020-21. So whatever the income you earn in the previous year will be charged to income tax only in the assessment year, that is 2020-21. Now you might also understand what is previous year. So because two times the word has coined here, right? Now let's see what's the meaning of previous year. So previous year in the sense, as per section 3 of Income Tax Act, it means the financial year. So what is financial year? Remember, in India, financial year begins from 1st April and ends on the next year of the 31st March. So that is a financial year. So it means the financial year immediately preceding the assessment year. So that preceding in the means before the assessment year. So before the assessment year comes, there is a previous year. So it means the financial year immediately preceding the assessment year. So as mentioned earlier, okay, the income earned during the previous year is taxable in the assessment year. So whatever the income that you earn, for example, now in this year, so this year is the financial year, will begin from 1st April 2020 and it is continuing. Now we are in the month of November. So it will continue till next 31st March of 2021. So this is the previous year. So whatever the income that you earn during this previous year, you have to pay in the next previous, in the sense assessment year. Okay, next previous year is assessment year for this previous year, that is 2020-21. But there is one exception. In case of business or profession which is newly set up during the financial year, the previous year shall be the date of setting till 31st March. For example, you have set up a business. Okay, you have set up a business on January 1st. So in this case, the previous year will be from 1st January 1st to 31st March, only 3 months, because other rest of the other months there was no income. So for example, if you have started your business from 1st November, so previous year will start from 1st November, not from the 1st April. This thing you have to remember. There are certain cases where income of previous year will be assessed in the previous year itself. I have used the short form here, previous year, P.Y. So certain cases, the income of a previous will be assessed in the same year. Usually income of the previous year will be assessed in the assessment year, right, and the next year. But in certain cases, and that there are certain exceptions where income of the previous year will be assessed in the previous year itself. What are those exceptions? The first one is shipping business of non-resident. So if you are running a shipping business, okay, then you have to pay your income tax, assess your income in the same year, because since you are a non-resident, you are running a shipping business. Next year we are not sure, in the sense income tax department is not sure that you are there in the same place or not. You may move to some other country, so that's why the previous year is same as, okay, assessment year. Then person, second one, persons leaving India without intention to return. Yes, so there will be some persons who are leaving India without intention to return. For example, there are certain businessmen, I don't want to name it. Okay, there are certain businessmen who were, okay, who were stopped from moving from India to other country. Recently there was a news, okay, the BR Shetty, yes, he was stopped in the airport to move to another country. Okay, then Vijay Mallya also was stopped, but somehow he has gone to London. Okay, that's a different issue. So persons leaving India without intention to return, because they won't return, that's why. So the for them the previous year will be the same as assessment year. So they have to pay the tax in the previous year itself. Then AOP. AOP means association of persons, or BOI, body of individual, or artificial juridical person formed for a particular event or purpose. Okay, so these association of persons, body of individuals can be for a special purpose. It may not run for many years, so that's why. So the income earned by this AOP, BO and artificial juridical person has to be taxed in the same year, because we are not sure that whether they are going to run in the next year. So persons likely to transfer property to avoid tax. Okay, there are persons, in order to avoid tax, what they will do is they will transfer their asset. Okay, in the next year they will again bring back that or transfer that asset into their name itself. So they will transfer the asset in some other name. The next year they will transfer the asset into their name. So such persons have to pay tax in the same year. So in order to avoid tax. Then discontinued business. So discontinue means there is no business. So in that case, it's natural, it's obvious that you have to pay tax in the same year. Okay, not in the next year, in the sense not in the financial year. Okay, then, so these are the five cases, uh, exceptions, where previous year itself will be assessed as, or will be treated as, where they have to pay the income tax. So in the they have to pay tax in the previous year itself, not in the assessment year. Okay, let us go to the next definition, that is gross total income. So gross means what? It's an aggregate. It's not completely total income, it's aggregate. So gross total income in the sense it's aggregate income computed under various heads of income after allowing set off of losses according to the provisions of the act. So it's the aggregate income from computed under various heads of income. See, in income tax, there are five heads: income from salary, income from house property, income from business or profession, income from capital gain, and income from other sources. All these five sources are computed. Income from all these five sources are computed, and whatever the income that you get is known as gross total income. Okay, after allowing set off of losses and carry forwards. Next, total income. So what is total income? So once you get the gross total income, then you have to allow the deductions. So once all the deductions are minus, then what income you get is your total income. So it is a gross total income after making deductions from 80C to 80U. So there are various deductions, okay, starting from 80C. Okay, 80C, 80C, then 80D, 80E. It will continue till 80U. So we have to allow such deduction if it is available to such person. Then casual income. So what is casual income? As the name indicates, casual means it's irregular, it's not regular income. So any income which is unanticipated, so you don't expect that income will come, right? Or irregular, so it's not regular, it's non-recurring in the sense it will not occur again and again. So it's completely non-recurring in nature. It arises from unknown source and no effort is made to earn this income. So it arises from unknown, so we do not know from which source it will come. Okay, there is no definite source or no effort is made to earn this income. Such income is known as casual income. So example, winning from a lottery. So no effort is done. We do not know from where it will come, money from where it will come. Income from crossword puzzle, income from horse race, etc. are known as casual income. Then the last one, basis of charge of income tax. How the income tax is charged. So section 4 of the Income Tax Act 1961 is the charging section. So it tells how the income has to be charged. So section 4, remember, it's a charging section. So which provides that tax shall be charged at the rates prescribed for the year by the Annual Finance Act. This is very important. Okay, so here tax will be charged at the rates prescribed for the year by the Annual Finance Act. Annual Finance Act in the sense the budget, whatever the proposed by finance minister, and it will be approved both the houses of the parliament, then it will become act. So in that act, what they have mentioned, for example, now the tax slabs for this particular previous year, that is for us the previous year is 1920, so will be of that year's budget. Okay, what they have mentioned, so that will be taken as the prescribed tax rates for that year. Then the charge is on every person specified under section 231. So we have already learned who are the different kinds of persons. It may be individual, partnership, firm, association of person, body of individual, then company, artificial juridical person, all these are known as persons. Then tax is chargeable on the total income earned during the previous year. So I have already told you while discussing assessment here. So tax is chargeable on the total income that you earned during the previous year. The sense it's a current year. When you are working, then it is known as a current year. That itself is a previous year. Okay, and not on the assessment year. So assessment year is next year where you have to pay the tax. Then tax shall be levied in accordance with and subject to the various provisions contained in the act. So this is very important. So whatever the provisions contained in the act, in accordance with that, tax will be levied. Okay, completely based on the tax. So I cannot say, government cannot say that you have to pay this. No, what act says, based on that you have to pay the tax. Then, last slide of this session, steps for computation of total income and tax liabilities. Very simple. How to calculate the total income. So this is what for us important as a tax student. So what is total income and what is this tax liability? This is what we have to find out in entire income tax. Okay, how it is done. So first one, you determine the residential status. So first thing you have to identify whether he is resident in India or not. So if he's not resident, if he's non-resident, then he doesn't have any obligation to pay income tax in India. Only some incomes are taxable. Okay, he need not pay income on his all the okay sources. No, he has to pay only certain incomes. Okay, on certain incomes. So first you have to determine whether he is resident in India or not. Then second one, classification of income under different heads. So once you decide whether is a resident, then you start okay assessing the income from various sources. So there are five sources or five heads of income. Compute one by one. Income from some salary, how much? Income from capital gain, how much? All these things you have to compute. Then computation of income under each head. Okay, separately you calculate because each head has a separate way of calculation, and there are certain deductions also in each head, so that we have to calculate. Then clubbing of income of spouse, minor child, etc. If you have clubbed income of the spouse, along with the income, that has to be seen. Okay, for example, wife's income. Okay, wife's, you have clubbed your income with the wife's income. So in such cases, wife's income is your income. Minor child, so minor child will not pay any tax, so you have to pay tax. So you have to club your spouse income and also minor child income. Then set off or carry forward or set off of losses. If there is any set off of losses, if there is any carry forward, that has to be done here. For example, in short capital gain, there will be losses which can be, sometimes it may be carried for next year, because if the total income from capital gain is 50,000, if your loss is 2 lakh, then you can claim only 50,000 as a loss, is it not? Rest 1 lakh 50,000 can be carried forward to next year. So that has to be done. Then sixth one, computation of gross total income. Now you arrive at GTI, that is gross total income. I have already told you what is gross total income. Then seventh one, deductions from gross total income, that is ATC to ATU. Various deductions are available. Then eighth one, computation of total income. So once you give the deduction, then you compute the total income. So after total income, compute the tax liability. So this is the broad steps of computation of total income and tax liability. So thank you for watching this video. Okay, you hope you like this video. Thank you.